Hello, everyone. In the next few hours, something is going to happen that most people won't notice until it's already priced in, and by the time the headlines catch up, the easy move will be gone. Because right now, gold and silver aren't behaving like trades anymore. They're acting like pressure valves. And when pressure valves fail, they don't fail politely. Here's the part that should make you sit up straight. The paper price can dip, the charts can flash red, the talking heads can smirk, and the real metal still gets vacuumed up faster than it can be replaced. And that tells us we're not watching a normal market cycle. We're watching a system slam into physical constraints. Before we get into it, quick note. I'm running a campaign to push back against copycats and low-effort re-uploads that try to ride the wave without adding value. So if you want to support what we're building here, subscribe and drop a quick comment, even if it's just Arjon AG, so the algorithm knows this content matters. Also, if you want daily updates, short posts, and my personal analysis that I don't always put on YouTube, plus instant voice notes and quick alerts, I've made a WhatsApp channel for the community. The link is in the description. Join it and you'll see why it's premium. Now, let's strip the noise away. Music. And I know that sounds dramatic, but let me prove to you why it isn't hype. When you hear record delivery, don't think of it like a statistic on a spreadsheet. Think of it like a warehouse door opening and pallets moving. Think of it like metal leaving the system instead of circulating inside it. That is a completely different kind of event than contracts changing hands. Since the modern futures era began in the 1970s, there have been plenty of loud moments, speculative surges, inflation scares, panic buys, you name it. But what we're seeing lately is different because the largest entities aren't playing the usual game. They are not renting exposure. They are taking possession. And this is where a lot of advisors, analysts, and market experts get it wrong. They keep talking as if gold and silver are just positions, like you can enter, exit, and forget about it. Like it's the same as buying a tech stock. But metals are not only financial assets. They are inputs. They are reserves. They are, in many cases, insurance against policy mistakes. That's why this moment matters. And that's why you should not treat it like a normal headline cycle. Now, here's the thing that makes this story uncomfortable for people who rely on the old system. The biggest buyers don't need your permission and they don't need your approval. They don't care if social media thinks something is overbought. They care if they can secure the material. That's why when you see a paper dump that happens in the dead of night, when liquidity is thin and a relatively small blast of contracts can knock the quote down, you have to ask the correct question. The correct question is not, why is the price down? The correct question is, did that push metal back into the market, or did it trigger another wave of physical buying? Because if it triggers buying, then the dump wasn't a bearish signal. It was a discount event. It was a clearance sale that only the most prepared people recognized in real time. And that leads to the next part, which is where this gets very, very interesting. A lot of people still think gold and silver move because of sentiment, or because the Fed sneezed, or because some chart pattern completed. And yes, those things can move the paper price for a day, a week, even a month. But what's building underneath is different. What's building underneath is that the biggest buyers on Earth are treating metal like a strategic input, not a speculative ticket. And that changes everything. When the real buyers show up, sovereign funds, industrial giants, state entities, the kinds of players who don't care about margin calls, they don't buy because a candle closed above a line. They buy because they need the material. They buy because supply chains don't run on promises. They buy because factories don't accept settled in cash. And once that kind of demand takes control, the old playbook starts breaking. So here's the story in plain English. For decades, paper has been able to set the price of metal. A contract, a promise, a derivative, a synthetic claim. Those things could outweigh the actual bars. You could create supply on a screen. You could print inventory in a database, but there's a problem with printing inventory. At some point, somebody asks for delivery. And delivery is where fantasy meets physics. That's why the most important data points right now aren't the hot takes or the memes or the top is in thumbnails. The most important data points are who is standing for delivery, how much is being delivered, how tight the inventory is, and what the market is charging to borrow actual metal. Because that's where the truth leaks out. And it's leaking out faster than people realize. Let's start with the thing that changed the mood in a lot of professional circles. Delivery volume. When you see a market hit the largest delivery month in modern recorded history, when you see tens of millions of ounces actually demanded and moved, what that says is simple. The metal is being pulled, not traded, pulled, and when a market is being pulled, paper tricks don't relieve the strain the way they used to. In the old days, you could smash the paper price at low liquidity hours, scare the retail crowd, trigger stops, force liquidations, and the selling would reduce pressure. But now, when the paper price gets smashed, something else happens. The physical is bought harder. The dip becomes a shopping window. That's not what happens at a real top. That's what happens when the market is short of what it's selling. And one of the loudest signals of that stress is something almost nobody talks about at dinner: lease rates. Lease rates are basically the rent you pay to borrow metal. In a calm, well-supplied market, that rent is tiny, sometimes near zero, sometimes fractions of a percent. But when the rent spikes, when it jumps into levels that make professionals blink, that's the market saying, we don't have enough readily available metal. It's not a vibe, it's not an opinion, it's a price signal. And when you combine high lease rates with something called backwardation, you're staring at the same message in two different languages. Backwardation is when buyers pay more for metal now than for metal later. Think about what that means. It means the market values immediacy. It means future supply is being discounted because the market doesn't fully trust it. In a normal world, people pay more for future delivery because time has value and storage has cost. But in a stressed world, people pay more to get it right now because the fear isn't price, it's availability. So when you see backwardation in silver paired with elevated lease rates, paired with unusually large deliveries, you're not watching speculation, you're watching urgency. And urgency is what breaks paper systems. Let me tell you what this looks like when it shows up in the real world. A tight market doesn't announce itself with a siren, it whispers. It whispers through higher borrow costs for the metal. It whispers through delays. It whispers through the way wholesalers suddenly quote you, we can get it, but not at that size, or we can get it, but not this week, or we can get it, but you'll need to lock it now. And then, one day, the whisper becomes a headline. That's why lease rates matter so much. If you have never watched lease rates before, here's the cheat code. In normal times, they're boring. They live near the floor. They are the kind of number nobody builds a thumbnail around because it doesn't sell drama. But when lease rates jump to levels that look more like a stressed credit market than a sleepy metals market, it tells you the system is paying up for access to real metal. And that matters because in a tight market, the price you see on a screen is only one piece of the puzzle. The other piece is the cost to obtain and deliver. In other words, paper can quote a number, but the physical market can charge a different reality. Now, here's a detail that should make you raise an eyebrow. We've seen situations where institutions publish confident notes suggesting silver has plenty of downside, calling for prices to drift toward the mid-range numbers again. And yet, those same institutions end up getting forced out on the other side when the market refuses to cooperate. Imagine telling your clients, it's heading lower, and then having your own risk controls trigger because silver surges far beyond your comfort zone. That is not smart contrarian positioning. That is a sign that the market is stronger than your narrative. And when forced buying starts, when stop-outs hit, those purchases are not optional. They are mechanical. Forced buying in a tight market is how accidents begin. Because the moment a large short has to buy back exposure, they aren't just buying a chart. They're competing against real buyers who want delivery. That's why a short in backwardation is not just risky. It's like stepping into traffic while the light is green, hoping everyone else will stop. So keep that in mind as we move into the next section. Now, here's where the story gets even more interesting, and this is where we get our first cliffhanger. Because if the market is this tight, why would a major bank step in and put on a massive short position? Why would anyone look at a backwardated market where the spot metal is at a premium and decide to bet against it? That sounds insane, unless they weren't choosing, unless they were trapped. There's a type of short position that is strategic and controlled, and then there's a type of short position that is defensive, forced, and ugly. When a player is short because they must be short, because the system requires it, because prior obligations exist, because balance sheets are leaning, then the trade isn't a trade, it's a patch over a leak, and patches work until they don't. So let's talk about what happens when a trapped short meets a market that refuses to loosen. First, they try the oldest trick. Slam paper at the thinnest times, get price down, restore confidence, shake out buyers. But when the price drops and the physical demand jumps, the trick loses power. Then they try the second trick, raise margin requirements, make it more expensive for leveraged traders to stay in. And this is where a lot of people are still mentally stuck in 2011. Back then, silver was a leveraged mania. Lots of players were using margin. When margin rules changed, those players got wiped. But the environment now is different. The buyers that matter don't care about margin. They're not trying to flip a contract. They're trying to secure supply. So margin hikes become speed bumps, not walls. And when margin hikes fail, the market is telling you something. The demand isn't coming from fragile leverage. It's coming from deep pockets and real need. And that's why this doesn't end quietly. Here's another piece people overlook. The rules have already been tested, and the market shrugged. We've seen margin requirements raised sharply. Think of it like the exchange saying, we're going to make this more expensive to hold. In past episodes, that would have drained the air out of the room. This time, it barely slowed anything down, because the buyers driving the flow aren't counting pennies of margin. They're counting tons and ounces. And when you see a market absorb a margin hike and still print one of the strongest delivery waves we've seen since the mid-70s, that's a clue that the underlying bid is not fragile. If anything, the message is, you can make paper more expensive, but you can't manufacture metal. So if you're watching this and you've been waiting for the system to cool it down, understand what you're waiting for. You're waiting for real demand to vanish or for real supply to surge. And neither of those moves on a dime. Also, quick community moment. If you've ever turned a tough financial situation around, paid off debt, built savings, started investing, grew a side hustle, drop a short comment about it. Your story might be the push someone else needs today. Because when a market is being fed by necessity demand, it becomes stubborn. It becomes relentless. It keeps pulling. Now, I want to slow down and make something crystal clear because it's the core of this entire conversation. There is a huge difference between price moving because people want to get rich and price moving because people must secure supply. Greed demand can vanish in a week. Necessity demand doesn't. And silver especially sits at a dangerous crossroads. It's both money and material. It's an industrial input, and it's a monetary competitor. And when an asset is both a strategic mineral and a monetary alternative, the incentives to control it get intense. Which brings us to another cliffhanger. If control is the goal, why is control slipping? Why are we seeing record deliveries? Why are we seeing tightness signals? Why is the system flashing scarcity? Here's my read. Control works when the crowd believes promises. Control works when the market accepts paper as equivalent to metal. But the second the market starts preferring bars over contracts, the whole structure starts wobbling. And the signs of that preference are everywhere. The buy the dip behavior is one. The rising cost to borrow real metal is another. The willingness to pay a premium for immediate delivery is another. The unusually high appetite for taking delivery instead of rolling is another. These are not retail behaviors. These are behaviors you see when serious entities want the stuff, not the story. Now, I can already hear the pushback, because it always comes. John, people have been talking about shortages forever. Yes, but here's the key. Talking isn't the same as measuring. It's not about rumors. It's about metrics. And the metrics are tightening. Let's talk about mine supply for a second. A lot of people assume supply expands easily, like you can just produce more. But mining doesn't work like that. New projects take years. Permitting takes years. Capital takes years. Skilled labor takes years. Equipment takes years. And in many jurisdictions, political risk, energy costs, and regulatory friction make just produce more a fantasy. So if demand accelerates while mine output stagnates or declines, you don't get balance, you get squeeze. And demand is accelerating in a way that is not obvious if you're only staring at currency headlines. Silver demand is being pulled by energy transition infrastructure, solar deployment, electronics, data centers, and increasingly by the hardware layers supporting AI compute and automation. And then you add defense and national security manufacturing, where redundancy and domestic stockpiles are becoming policy, not theory. When that wave meets a supply base that can't instantly expand, the market has two choices: ration via price or ration via shortage. And paper systems hate both. Because rationing via price means the quote has to rise, and rising quotes stress the short side. Rationing via shortage means delivery fails, and failed delivery destroys trust. So the system tries to hold the line with paper. But the more it relies on paper, the more it creates the exact behavior that defeats paper. Real buyers step in and take metal off the table. Now let's revisit the bank short story in a more general way, because I'm not here to obsess over any one institution. What matters is the pattern. The pattern is a large player takes a short position in a tight market, then issues commentary suggesting prices will fall while the market moves against them. That's not just ironic, it's revealing. Because when someone is confident, they don't need to sell you confidence. They just win. When someone is uncomfortable, they try to shape perception. And shaping perception only works when the underlying reality is loose enough to bend. But when the underlying reality is tight, when the metal is scarce, perception management loses power. And that's why you're seeing a situation where paper drops don't relieve physical stress. Each smash becomes an opportunity for real accumulation. That is the opposite of a blow-off top. Now, the reason I'm saying the next few hours matter in this video is not because I'm pretending I can predict a candle. It's because when a system is this tight, small triggers can create outsized moves. A delivery notice, a sudden spike in lease rates, a surprise inventory report, a big buyer showing their hand. Any one of those can flip market psychology from this is noisy to this is structural. And when that flip happens, the repricing is fast. That's why the loudest people in the room often sound the most calm right before the move, because their job is to keep you calm. Now here's where we take it one step deeper, because if you're still with me, you deserve the real meat. A paper-based pricing system relies on one core assumption. Most people won't demand the underlying asset. As long as most participants are happy to settle financially, the paper supply can be larger than the physical supply. But when more participants begin demanding delivery, the ratio gets dangerous. It's like musical chairs. If everyone thinks they can sit later, the music plays. If people start rushing for chairs, suddenly everyone realizes there aren't enough chairs. And the rush is what exposes the truth. So what you're watching in silver is a slow transition from music plays to people run. And once it becomes a run, the paper system has to either source metal at any price or it has to change the rules. And changing the rules is another way of saying confidence breaks. Now, I want you to think about this question and answer it in the comments because it tells me how awake this audience is. Do you believe the next major move in silver will start with a price spike or with a delivery problem? Drop your answer below. Here's the second question, and be honest. When you see the paper price get slammed at weird hours, do you think it scares people out, or does it train people to buy the dips harder? I want to see your thoughts in the comments. Now, speaking of comments, if any of you have had real success, whether it's investing, business, career, or just a personal financial win, share a short version in the comments. Not to flex, but to raise the morale of people who need proof that progress is possible. All right, let's keep moving because we're building to the part most people miss. When analysts compare today to 2011, they're focusing on the chart, not the cause. Charts can rhyme while the engine is different. In 2011, the engine was leverage. A lot of people were long with borrowed money. When the cost of maintaining that leverage rose, the longs were forced to sell. That selling relieved pressure. Today, the engine is physical pull. And when the engine is physical pull, forcing paper traders out doesn't solve the problem. Because the problem isn't paper positioning. The problem is real demand competing for limited supply. And here's where it becomes almost comedic. The tools designed to cool speculation don't cool necessity. Imagine trying to stop a factory from buying a critical input by raising margin requirements. They're not on margin, they're on deadlines. That's why these measures keep failing. Now let's zoom out and make this even more obvious. When you see a market where record deliveries happen, alongside higher borrowing costs and immediate delivery premiums, you're seeing the market price scarcity without being allowed to fully reflect it in the screen price. It's like the market is whispering the truth through side channels. And those side channels matter. Because smart money watches side channels, retail watches headlines. Smart money watches flows, spreads, and constraints. Now, I promised you retention, so here's the next cliffhanger. If the metal is tight and demand is strong, why do we still see sudden drops? Why doesn't price just grind higher? Answer: because the paper market can still move the quote, but it can't change the inventory. The quote is a signal. Inventory is the reality. And right now, the quote is being used as a lever to manage behavior. But the lever is slipping. Because the more often you slam price and it rebounds, the more you teach the market that slams are temporary. So the slams lose shock value. And when shock value is gone, the next slam can backfire because it brings in bigger buyers. So the system ends up in a trap of its own. And traps create accidents. Now, I'm going to say something that may sound dramatic, but it's practical. Market accidents don't start when everyone is panicking. They start when people think the system is stable, while the system is actually fragile. Fragility plus leverage plus tight supply equals snap moves. And you can see fragility in the behavior of the short side. You can see it in commentary that tries to talk price down. You can see it in defensive positioning. You can see it in frantic paper dumps that fail to produce lasting relief. So what does all this mean for you as a viewer? It means you need to stop thinking in terms of, will it go up today? And start thinking in terms of, what phase are we in? And I believe we're in a phase where the paper pricing structure is being tested by physical constraints. Now, I'm not telling you to do anything reckless. I'm not your financial advisor, and this isn't a trade call. I'm telling you to observe reality, because reality is what wins. And reality is that the world is consuming silver in ways that are not optional. Reality is that production is not keeping up as easily as people assume. Reality is that inventories and delivery flows are showing stress. Reality is that the cost of borrowing metal is rising. Reality is that immediate metal is being valued more than promised metal. And those are not the ingredients of a quiet ending. Now, before we go further, quick creative side note. Some of you asked me for real-world silver success stories, like how ordinary people positioned early, what they did right, and what they do differently. There's a separate channel that focuses on those silver-related success stories, and the link is in the description. If you want that motivation and those case studies, go check it out and subscribe over there too. Back to the core narrative. There's another angle here that most commentators avoid because it's uncomfortable. Criticality. When an input becomes critical, it stops being purely economic and starts being strategic. Strategic inputs get stockpiled, they get prioritized, they get protected, they get political. And the moment silver is treated as critical by industry, by policy, by supply chain managers, you get a change in buyer behavior. Buyers stop buying just in time. They start buying just in case. And just in case, buying is what drains inventory. Now add a second layer, technology. Technology demand isn't linear, it scales. When AI infrastructure scales, it pulls more servers, more power systems, more sensors, more connectors, more specialized electronics. When solar scales, it pulls more silver per deployment. When electrification scales, it pulls more components. When defense modernization scales, it pulls more high reliability materials. The point is, the future demand curve is not flat. So if supply is flat while demand is rising, you don't get balance. You get a competition. And competition means somebody pays up or somebody goes without. And when the buyer is a sovereign entity or a critical manufacturer, they will pay up because going without costs more. That is why this environment is so different from the meme coin mentality. Now, I want to bring this down to a simple metaphor. Picture a supermarket where the shelf says milk, $3. Now imagine the back room has almost no milk. The price tag might still say $3 for a moment. But the moment customers realize supply is thin, the behavior changes. People buy extra. People show up early. People take more than they need. People stockpile. And suddenly the $3 tag is meaningless. The real rationing happens through availability, not the sticker. That's what scarcity does. And markets are just sophisticated supermarkets. Now, here is where I want you to stay with me, because this is the part I think is most likely to go viral if people truly hear it. If the paper system is ending, it won't end with a press release. It will end with a series of small events that, in hindsight, were the dominoes. A record delivery month here, a sustained backwardation period there, a lease rate spike there, an inventory draw that doesn't refill, a sudden premium explosion in the physical market, a short squeeze that forces buying into a thin order book. And then one day, people will say, how did this happen so fast? It wasn't fast, it was building. Now, I want to address the argument you'll hear from people who want you to disengage. They'll say, if silver is so tight, why isn't it already triple? Because price discovery is being managed through paper. But managed doesn't mean solved, managed means delayed. And delay creates bigger moves later. Think of a beach ball held underwater. The longer you hold it down, the more energy builds. Eventually it pops up. Now does it pop up smoothly, or does it explode out of the water? That depends on how tight the grip is when it slips. That's why I'm watching the next few hours and the next few days with extra attention. Because in stressed systems, timing triggers matter. Now, let's talk about gold briefly, because gold is the quieter cousin, but it's part of the same story. Gold is the monetary barometer. It's the asset central banks respect. It's the asset that signals trust in currency. When gold is steady while silver is screaming scarcity through side channels, that can be the calm before the next rotation. Gold often moves first in a monetary reset theme, and silver often accelerates when the public notices. So if you're seeing gold hold strength while silver shows physical stress, that combination can be explosive. And that's why I titled this the way I did. Because you might not know what's about to hit gold and silver in a few hours, but the market structure does. It's telling you through the things that can't be faked easily: delivery, lease rates, backwardation, and flow. Now, here's another retention kicker. If this is the end of paper-based pricing, who is going to be the last person holding the paper? Because someone always is. Someone always believes the promise until the last moment. And that's why the messaging campaign matters. You'll see a flood of "it's over" narratives right before the next move. You'll see people highlight past tops and pretend the drivers are identical. You'll see confident calls that ignore physical constraints. And if you're not careful, you'll be emotionally guided out of a position right before the structural move. So here's what I recommend as a mindset, not financial advice. Stop letting daily noise dictate your conviction. Start watching the structural indicators. And ask yourself, are those indicators improving or worsening? From what we can see right now, they're worsening for the people relying on paper promises. And that's bullish for the people paying attention. Now, let's layer in the story of industrial buyers one more time, because it's important. Industrial buyers are not like you and me. They don't wait for a pullback when production lines are on the schedule. They don't say, let's see if RSI cools off. They secure supply. And when supply becomes uncertain, they secure more. So even if the headline price dips, their behavior can still be to buy, because the risk they manage is not price, it's interruption. That's why you can have price down days with physical tightness up. That divergence is the stress fracture. Now, I want to add something else that can create sudden moves: policy and classification. When governments start labeling minerals critical, it changes who can buy, who must stockpile, and how funding flows. It can trigger procurement programs, subsidies, strategic reserves, and industrial policy. And those policies often move quietly until they don't. So if you see a sudden policy shift around strategic materials, don't be shocked. It's part of the global reality right now. Supply chains are national security. Now, you might be wondering, okay, John, if this is structural, what are the signs that an accident is near? Here are a few general signs, and I'm sharing them so you can think, not so you can panic. 1. Repeated price smashes that fail to produce a lasting downtrend. 2. Lease rates that remain elevated or spike higher. 3. Backwardation that persists or deepens. 4. Unusually large delivery notices or delivery months. 5. Widening premiums in retail or wholesale physical markets. 6. Suddenly aggressive official messaging that tries to cool enthusiasm. When several of these line up, it can mean the system is under strain. And strained systems don't move smoothly. Now, let's give this story a human face because people connect to humans, not charts. Imagine you're a procurement manager at a high-tech manufacturer. You get a memo. Supply of a key input is getting tight. Lead times are uncertain. Vendors are hinting at allocations. Do you buy less or do you secure more? You secure more. Now, imagine millions of procurement managers across the world doing that with different materials. That's the commodities supercycle behavior. It's not speculation, it's survival. And silver sits in the middle of that. Now, I promised I'd keep this engaging, so here's the next cliffhanger. What happens when the public finally realizes that the paper price is not the same as the real cost to obtain? Because that gap is already appearing in different ways. Sometimes it shows up as premiums. Sometimes it shows up as delays. Sometimes it shows up as rationing. Sometimes it shows up as different pricing depending on size, form, and location. But once the public understands the gap, the psychology flips. And when psychology flips, metal becomes a magnet. That's when you can see a feedback loop. Price rises, attention rises, demand rises, supply tightens, price rises again. And that's when people who waited for confirmation realize confirmation is expensive. Now, let's do a quick reality check on the top is in crowd. At real tops, you usually see something like this. Everyone is euphoric. Everyone is leveraged. Supply is ample. Borrowing costs are low. Future delivery is trusted. Physical demand cools as price rises. And then when price turns, it turns hard because the market was full of weak hands. What we're seeing now doesn't match that. We're seeing urgency for immediate metal. We're seeing elevated borrow costs. We're seeing record delivery behavior. We're seeing dips being bought physically. We're seeing demand drivers tied to infrastructure, not memes. So calling this just like a prior peak is lazy analysis. It's analyzing the shadow, not the object. Now, I want to talk about one more element, the psychology of institutional denial. Institutions hate admitting structural issues. They prefer narratives that imply normality, because normality keeps people calm. Calm people stay in paper, so you'll be told this is temporary. You'll be told supplies can be ramped easily. You'll be told demand will soften. You'll be told innovation will reduce usage. And yes, efficiency improvements happen, but structural shifts also happen. And in a world where demand scales and supply is constrained, the burden of proof should be on the it's fine crowd. Now, we're coming into the final stretch, but I want to make sure I've hit the required updates for the community. 1, join the WhatsApp channel in the description. If you want daily posts, instant voice notes, and quick alerts I don't always share here. 2, by the time you're watching this, the members-only video should already be live. Join the membership, and you'll get a single clean video that ties together the updates and the deeper analysis, plus more in-depth breakdowns going forward. And honestly, it's also a way for me to see who is really following closely. Now, let's wrap the market story with a clear, memorable takeaway. Gold and silver are not just numbers on a screen. They are confidence indicators. They are strategic inputs. They are scarcity assets. And the market is giving you a warning through its plumbing. When the plumbing gets noisy, the pressure is building. When the pressure builds, the move can be sudden. So what should you do right now? You should stay informed, stay calm, and stay ahead of the narrative. And the easiest way to stay ahead is simple. Subscribe. Short and effective. Hit subscribe so you don't miss the move. Now, one more thing for engagement and community. If you've done well in the last year, maybe you hit a financial milestone, maybe you paid off debt, maybe you grew your business, share one sentence in the comments. I read them, and other viewers get real motivation from real people. And if you haven't had a win yet, comment anyway. Comment our John A.G. so the algorithm pushes this out. And so I know you're here and you want better. Because what we're building is not just another channel repeating headlines. We're building a community that spots structural shifts before they become mainstream. One last reminder, the goal isn't to predict every wiggle. The goal is to recognize the regime shift early before the crowd is forced to react. If you're still here, you're ahead of most people already. So protect that advantage and stay plugged in the WhatsApp channel and in these weekly videos. All right, final cliffhanger to leave you with. If the paper pricing system is cracking, the next phase won't be announced. It will be felt. And the moment it's felt, gold and silver won't ask permission to move. They'll just move. Stay ready, stay sharp, and I'll see you in the next one.